This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
South Garden in for the 142!
Warren Buffett.
Carl Icahn.
John Templeton.
Buy low, sell high. Fear, that's the other guy's problem.
Dan Druckenmiller.
George Soros.
Paul Peter Jones.
Peter Lynch. You ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
My guest for this episode is Bill Fleckenstein. I've been really excited to share this one. We recorded the interview back in late May when I made a trip up to Seattle, and Bill was kind enough to invite me into his home. We shared a bottle of wine and chatted for well over an hour, but it just flew by. For those who don't already know Bill, for the past 30 years, he has run money for Bill Gates. He has witnessed and profited from 4 financial bubbles and honed his palate for white Burgundies, which is one of the wines we were drinking as we recorded this conversation. As I normally try to do, I use this opportunity to really try to dig into Bill's process to find out what has made him successful as a short seller during these massive financial bubbles when it can be very dangerous to try and trade from the short side. So we talk about tactics, we talk about central bank policies, the problems they create, the problems that they pose for investors. We also talk about what Bill sees as the fattest pitch right now for short sellers in the markets, and also the greatest risk facing the average investor today. So without further ado, please enjoy my conversation with Bill Fleckenstein. So Bill, welcome to the show. Thanks for doing this. It's a real pleasure for me to have this opportunity to chat with you like this.
Yeah, well, it's fun for me too. So let's dive in.
Yeah, I thought I was a wine snob because I don't like to drink the stuff out of a box, but you're a real wine snob. What?
Yes.
Tell me about. We're drinking a couple different wines here. Tell me about your wine passions.
Well, I started collecting wines in the early 80s, and it was a function totally serendipitous. I mean, I was always like a Bud Light drinker.
Yeah.
And I bumped into a buddy of mine from high school. He was working in a wine shop, and we had just bought a new house and it had a quote-unquote wine cellar in it, which is to say it had a little compartment downstairs where they had shelves for wine. So I figured since we had a wine cellar, maybe we should learn about wine. And my wife actually knew more about it. She'd been an analyst in New York and she was a tech analyst at Kidder Peabody, and they had a nice big expense account, so she knew a lot about some of the nicer white Burgundies. So we started trying wines, and one thing led to another, and we both settled kind of on Burgundy was what we really liked, and particularly white Burgundy. So just one thing led to another, and here we are, 30 years later with 8,000-9,000 corks in that thing.
Well, if you're going to drink wine, why not drink something that's worth drinking? Right?
Exactly.
Yeah.
Life's too short to drink bad wine.
Absolutely. I tell my wife this, she goes and buys wine at the supermarket, and I said, why don't we just join some of these wine clubs where you get the wine at a good price, but you actually get good wine?
Yeah, well, some of the like I have a really good friend of mine is the winemaker and owner of Andrew Will Winery, which he's a really talented guy on a national, international scale. And he has a wine blind tasting club, and you get a couple bottles a month, and it's usually stuff that he has too small, extra barrel of this or whatever, and a bottle, and you get to try stuff you wouldn't ordinarily get to try. Ridge has one of those. There's a lot of places that have those, but oftentimes it's a good deal because you'll get a couple bottles you would never see, and you'll learn about different grapes and different things like that, and you can actually learn a little something. Sometimes I'll have friends that come over and say they know I have some wine. They'll say, well, don't waste the good wine on me because I can't tell the difference. I say, really? And I'll pour them a glass and say, wow, this is really good. And I say, see, you don't have to be very sophisticated to be able to tell if it's good or not, right?
Yeah. Yeah, and it's funny in terms of investing. When I first thought of the term wine snob, I wrote a post like a year ago or something about the virtue in being a snob in terms of investing. That I think it was Jim Rogers or somebody said, don't commit capital until you have a really, really good reason to do that. So it's kind of the same thing, right? Don't don't buy a wine just to buy
Don't
wine.
waste those.
Yeah.
Waste those brain cells on some dodgy wine, right?
Right, absolutely. And don't waste your capital on ideas you kind of like or you think might do okay. Waste your capital on ideas that you really think you really love and you really think is a great opportunity.
The longer that I've been at this, the more I find that it's not so hard anymore because I've been doing this long enough now. But not doing anything when you don't like what you're seeing or the setup or whatever is really important for two reasons. Number one, you save your grief and your potentially your capital and all of that. But then secondarily, it's easy enough to be wrong when you're sure that you're right. So if you go into some situation kind of lukewarm, I mean, how the hell are you going to make any money unless you get lucky, right? Right. So I go days and days and days without doing a trade.
Yeah. So
that for me that's okay. I mean, other guys do it differently. I'm looking on a longer term time horizon or so. If you could use the same sort of discipline. Even on a day trading, you might look at 1,000 in a day and you only take 2 or something like that. But, it just...
Well, it reminds me of another, discipline outside of investing, which is music and probably most appropriately jazz. They talk about the space in between notes, that you listen to good jazz players. I don't know if you're a jazz fan, but, and it's when they're not playing, that how they use the empty space is really, really valuable. You hear guys that just blast notes and, like, okay, that's amazing that you can do that, but I want to listen to it, right? You need to use the empty space.
I hadn't thought about it that way, but, that kind of speaks to timing, which is obviously investing the timing.
When not to play or when not to commit capital.
Exactly.
So, you didn't start in finance. Were you, I think, if I remember correctly, you were in software or something originally?
Yeah. So I was a math major, but I took a lot of computer science classes. They didn't really have undergraduate degrees in that. This was the mid-'70s. But I was pretty interested, and I took a lot of different classes in programming, and it just so happened that I got a job because the Burroughs Corporation needed somebody who could program an algol, which I learned because they had a big Burroughs machine at the UW, and they needed a tech for a local company had bought the big machine and they were promised. So I was in the right place at the right time, and I got a job writing software, but I did that for a year and a half, 2 years, and I was really bored with it. And had an interest in investing. I'd sort of kind of gotten interested in it, and so one thing led to another, and so I left the software business to become a broker at Kidder Peabody, which is how I ultimately met my wife.
Yeah, so you transitioned to Kidder Peabody, and you were a broker. And was that here in Seattle?
Yeah. I was a broker. Pardon me?
That was in Seattle?
Yeah. And I was a broker for a couple of years, and then there was a local money management firm that had started, the first one that had been started in Seattle in about, I don't know, it might have been 10, 15 years. And they were kind of expanding, and so they so then I joined them, and we had, and did that. It was mostly a value-oriented investment firm. It was a value-oriented investment firm, and we had, and I basically did that until about 1996 when I left to go start a short fund, because I was fairly certain that what Greenspan was doing was going to lead to problems, big problems. And I thought that being a value investor wouldn't work all that well, given what he was doing and given the trends in the industry towards consultants doing what they tend to do and all that. So I thought it was going to be a tough time. So I thought, well, I'll go be a short seller. I'll get away from this, and then I can come back and run money on the long side again. It'll be easy for me to raise money because I will have differentiated myself by saying, look, these are bad policies. They're going to lead to trouble. I'm not going to be part of it. And then when sanity returns, I can go back to the long side. It was a pretty good theory. And but it was a long ways between 96 and March of 2000 when the market finally cracked. And then, of course, it turns out that the idiots at the Fed, they didn't get any religion about their bad policies, and the public didn't either. And I believe that in addition to all the lives in turmoil that 9/11 created, it let the Fed off the hook. So that everyone blamed the economic weakness on 9/11 when economic weakness had already begun and was a consequence of the bubble bursting. So anyway, one bubble led to another, and so then I never went back to the long side. I stayed in the battle on the short side until the real estate bubble imploded.
Well, let's come back to that decision to switch to a short-only fund because, and by the way, the firm that I co-founded in late 97, one of the funds we started was a short-only fund in the end of 97, early 98, which was a very difficult time to do that. So I can sympathize with what you went through in that period. But what really, about your character or your mindset, I guess what inspired you to, besides the policies, I guess what is it about your personality or whatnot that helped you see what most everybody else really didn't see about the dangers of these policies creating a bubble and et cetera?
I don't think I did anything special.
Everybody else was, jumping on the day trading bandwagon. And,
I can't. Part of it may be due to the fact that for some odd reason, ever since I was a little kid, I had a kind of an not unusual, but I had the whole concept of what happened in the Depression and money being scarce and all this stuff really affected me. And my mom was telling me stories about when she was a kid and stuff like that. It always stayed with me. And so after I had been short Tokyo, the Tokyo market for myself and for one of our clients, we obviously didn't short as an organization, but I did have one client that wanted to do that sort of thing, and so I did it for him. And so I'd been shorting some stuff. I'd been shorting for him in 94 and 95 and myself. So I had some idea that I had a belief that I knew kind of what to do. As I look back on it, relative to what I know now, I didn't know anything. But nonetheless, I'd had the experience, and given what I saw in Tokyo and given these policies, I'd spent a lot of time reading books about the 20s and the Depression, and I was just certain that what we were doing was similar to what happened in the 20s, and was going to lead to real trouble when it ended. So I didn't see how I had any choice. To me, I had no choice. I couldn't stay on the long side. The run-up to what was going to the run-up was going to make value investing extremely difficult. That turned out to be true. So I felt like we'll lose our clients because we won't be able to do what we need to do. We won't be able to get it right about when it turns. And then after the trouble hits, then I go back to the long side. That part of the analysis was all wrong.
we're still waiting for that part of the analysis.
Exactly. So I for whatever reason, I think the root. Had I not had such a sort of a infatuation or sort of spent so much time reading about the 20s and the Depression and all that, probably I wouldn't have done what I did had it not been for that. I guess that I think about it.
I think there's two types of people that I meet, and one are the people who understand cycles, that markets move just like nature, right? And we have seasons and cycles. And then there are other people that think that it's really just one long upcycle, and there never will be another down cycle like we saw in the Depression again. And whether that's faith in the central bank or faith in American ingenuity.
I don't think any of those people that you're talking about live in Greece now.
Right.
Those people have found out that when you can't kick the can anymore, life gets tough.
Or you talked about Japan. You look at where Japanese equity and real estate prices today versus where they were in 1990. One of the things driving this bull market is the idea that buy and hold will work because the market's never been down over a 20-year period. And I think, Japanese would look at that and go, laugh, right?
Right.
Like, yeah, markets can be down 20 years, over a 20-year period. So I think that's, being willing to look through the cycle and say what's coming on the other side of the cycle is something that not a lot of people are willing to do.
I think also it's this particular period, and by that I mean Greenspan changed the nature of central banking because, I feel, and obviously I'm biased, I wrote a book about this, that he was never very good at being an economist or anything else. I mean, most economists aren't particularly useful. I mean, nothing against them, but if you look, I mean, they don't add much value, I don't think. And he didn't either. He wasn't very good at being an economist. And I could share with you some quotes, and they're in the book, and I won't bore you with them. But I believe his ego got to him, and he liked being the guy. And he started looking at the stock market, and basically ran Fed policy on the applause meter that he was getting from the stock market. I chronicle in the book all the times they should have done something, they didn't, and they said they would if this happened, and then that would happen, and they wouldn't do it. I mean, the biggest criminal act that he had, I think, probably was the rate cuts after long-term capital, the fall in 98. They said, we'll take them out if we need to. And then speculation got wild, and they didn't even talk about it. They would have FOMC meetings, and the stock market wouldn't even come up. Mike Prell one time in a meeting talked about, I think it was Red Hat, some, thing went insane like a lot of those stocks did. And he mentioned it was similar to the South Sea bubble. He brought the prospectus in. Didn't get one comment. So they were sound asleep. So I think Greenspan was, I really disliked him because of the fact that I thought that he, not having been a very good economist, ought to have known better. I mean, this nonsense about irrational exuberance. I mean, well, if he really, people talked about him like he knew what he was doing. That was in 96.
Right.
If he really had any concept and knew that, where was that thought over the next 4 or 5 years? So he started this sort of being too easy, and that created the bubble. And then of course, after that, they were deemed to be the firemen riding to the rescue as opposed to the arsonists that started the fire. And of course, they were both.
Right.
And they didn't get tagged with that. And then Greenspan didn't learn anything from the first one. He's out cheerleading for the housing bubble, saying it can't be a bubble. You can't. He said this. The quote's not going to be exact, but it's pretty close. You can't have a bubble because you can't arbitrage real estate in Portland, Oregon, and Portland, Maine. I mean, that was one of his arguments. He was giving speeches about why there couldn't be a bubble when there was one raging. So he started this, what I call the activist central bank era, where he was going to go in and tweak things. And then of course, that ended in a disaster. And then we got Bernanke, who was epically clueless. Yeah. I mean, how a guy could have studied the Depression and come to the conclusion that the Fed didn't do enough when what the Fed did in the first place in 27 and 28, which caused, and never when those guys go on TV does anybody say, hey, wait a second. You guys it wasn't what you didn't do in the 30s, it was what you did in the 20s. They never get called on that. So anyway, I've gotten off on the tangent, but these activist central bank era, it means they have pursued, you and I might agree, or probably agree, they have pursued bad policies for the better part of 20 years. But there's only been about 3 years of pain. There was 2000 to 2002-ish, there was pain in the market and the economy. 2008 was compressed into a year. It should have scared people off of this kind of policy, but it didn't. So you've had 3 years of pain, and now we've had 8 years of up, where basically 1 and 1 could make 5 any number you wanted, whether you want to talk about real estate, art, stocks. So this is a long way of saying people have been trained that, these little bumps happen, but they don't last very long, and they don't remember them. So they've had 3 bad years out of 20, And they don't remember that. And the newer, so you got a whole generation of people who don't have any idea that stocks can go down for more than 5 minutes. And now in the last 8 or 9 years, they haven't. So what I'm trying to make a point is, it's not shocking to me that so many people believe this nonsense. And you have to have real sense of
extrapolating the last 20 years.
Yeah. And 20 years is a long time, especially if you're only 30.
Yeah, actually,
or 40.
People, right.
And the thing of it is what I've learned is really, really bad policies can persist for way longer than you would think possible. The Soviet Union took 70 years to collapse, plus or minus. We see them try over again in, Venezuela. It's been taken a decade for that thing to fall apart. So bad policy. So, a decade's not a long time in history. 70 years isn't. But measured in people's lifetimes, 10's a decent chunk. 70 is a whole lot. And so we have a whole generation of people who have no clue about how markets really have worked historically, and they think that we're in some new era. And, of course, with human nature, there's never any new eras.
Right, yeah. And every time they say it's a new era, that's the time your antenna should go up. But, it's whatever you think of, Donald Trump, we are seeing kind of a global anti-elitist movement. It seems like to me, what are your thoughts on that? And how do you think, these policies are eventually going to be fixed?
I think,
this is I'm hoping.
No. I think the problems that created Donald Trump was, quite frankly, the Fed.
Right.
It slays me. I think Paul Krugman he's a very bitter human being, judging by, I can't even read his writings, but he's a complete idiot when it comes to economics, because he rails constantly against the 1%, like they did something wrong to get that way. But anyway, and he advocates for the Fed to do the very things that the Fed has done, which created the bifurcation of the 1% between them and everyone else. So I think Trump was elected because enough people in America are fed up. Everyone who voted for him knew he was a wild man, thin-skinned, egomaniac, prone to do anything. But they said, you know what? I am so sick and tired of the status quo, because I don't see how the status quo is ever going to do me any good. And they may not be able to articulate it as the Fed, and I might be wrong in my analysis. I don't think so, but And so that brought us Trump, and that's brought other changes other places. People are fed up. The central bankers are the elitists. You got 8 or 10 people in a room, making up these policies, and they've never been right in their lives, basically. And these policies are completely warping markets all over the place.
Well, it's wild for them to say, we are trying to create a wealth effect to help the economy, but we're not responsible for wealth disparity.
Yeah, right. Right.
It's ridiculous.
And by the way, they're probably all the kind of people that say, "Oh, trickle-down economics doesn't work," when that's the exact same thing they're trying to do.
Right. Exactly.
The portfolio balance channel.
Yeah. Well, what are your thoughts on the Taylor rule and basically just going to more of a systematic type of a policy?
Look, there. On the one extreme, on the one extreme where things are anchored, you have the gold standard. On the other extreme, you have what we have today, right, where they pick a rate, negative whatever, and they make up whatever they need to do. They change the rules. We want more inflation, except they specifically have built an index in America called the CPI, which almost cannot register inflation no matter what, because of how it's constructed. I wrote half a chapter in my book about that, and I still to this day don't see why people don't talk about the fact that the CPI is complete garbage in terms of an index. But in any case, so there's nothing that gets these people. There's no accountability. There's no accountability on the central bankers or what they do, and. So they're winging it, and so now we've got these group of people who are constantly winging it, but they have no idea what they're doing, and so the least bad monetary policy is the gold standard, okay? because of its checks and balances and the fact that it tends to put a brake on lunacy sooner, which means that you can't kick the can as long. It means the hangover from the party isn't as bad, and you can't spend 20 years not dealing with issues you should have because you can keep kicking the can. You can't really kick the can on the gold standard very well, right? I mean, we did manage to have the 20s and then the 30s, but also the gold standard was around when we had the big bust in 1920 and the boom that lasted for 9 years after that was messed up by the Fed. So I think some variation. What Volcker tried to do was the monetary equivalent of the gold standard, whereby he said, "Okay, we're gonna focus on the quantity of money." Now, you can't really know; there's no precision. But he said, "Look, we got a rule. At least he had a rule." So, since I think these central bankers are also incompetent, I favor the gold standard just because I don't want them making decisions. The gold standard doesn't really require an FOMC,
right?
Much.
But like you pointed out in the 20s, we were still on the gold standard, but
we were on the gold exchange standard, which is slightly different.
But the Fed got
We'd need
way
Jim
too easy
and
and created this.
Right.
I mean, the
right.
28, 29,
exactly.
disaster.
Exactly. So, I mean, we'd need Jim Grant to give us the fine details between the gold and the gold standard and the dollar gold standard.
Right.
Having said that, I mean, then we could argue that the 30s turned out to be the 30s because of the policies of the government and other things too. So,
well, it's encouraging to me to see this anti-elitist movement from the standpoint that if there's anything to take the power out of the hands of academics trying to micromanage the economy, the movement towards more populism might be a wave of something that could usher in hey, let's take away the discretion at the Fed and come up with systematic policy.
But I don't think the voters can do that.
Right.
So the stock market's not going to take. What I like to say is the printing press has to be taken away from the central bankers. So and
that's probably where we go back to a gold standard. You have that type of a development where, and you're talking about the printing press taken away, meaning the bond vigilantes.
Well, so it turns out that there never really were any bond vigilantes. There were only yield pigs.
Right.
And the slope of the yield curve created the lack of bond buyers. It was so massively negatively inverted that it was so steeply inverted. That they talked about the bond vigilantes. This is the slope of the yield curve, but the yield curve was as it was because Volcker was doing what he was doing.
But I think of bond vigilantes in terms of the people who say, okay, wait, the government finances are getting out of control.
Yeah, well,
that's I'm not going to lend money.
No. That's what we need.
Yeah.
My point was, if they ever existed, where the hell are they now?
Right, yeah.
So what I'm saying is, the bond vigilantes got credit for the backup in rates and when Volcker was involved, and there probably were some who said, wait, this is the wrong rate. But more likely, it was the yield pigs who like to take bonds and lever them up that couldn't lever them up when the curve is inverted. They can lever them up when it's normalized.
Right.
And so what I do mean to say is, at some point, coupon clippers, fixed income owners who ought to be the real vigilantes will say, look, I'm not taking this 2% coupon or 1% or minus 10 basis points when inflation's running at 2, 3, or whatever, than 4, whatever the number is. And when the bond market, when a central bank loses, one of the G7 central banks loses the bond market or the currency market, it's game over.
Well, so how do they? The question I have is, how do they lose the bond market when they're in the bond market so heavily?
That's a great question. But the answer is, when the market changes its mind, the central banks don't necessarily win. Now, we've seen that to some small degree. It took about a year of easier money in 01 to 02 before the markets got confidence, before the stock market got confidence again. Same in 08, they were easing and it didn't work. People are scared. So we've seen a little bit where the stocks, at least, haven't quite believed it would work, right?
True.
So there was the the feds and everyone doing what they're doing, and they didn't believe it, and it didn't work because they didn't believe it. Now we'll talk about bonds. There's the pile of fixed income in the world is so enormous that if the collective mood of the bond owners in the world decide that they're getting cheated on the rates, or they start to think about inflation, or they think that the central bank can't ride to the rescue or whatever, rates will start to rise. And when rates start to rise and it's not sponsored by the central bank, which is going to happen, I believe is going to happen, then all of a sudden you take the printing press away. When the central banks cannot ease and have the bond market jump higher in Pavlovian fashion, when they ease and the bond market goes down, it's game over. Then you've taken the printing press away from them, and that means they can't ride to the rescue for the stocks or the bonds, and then you're going to have a real train wreck, and we will have to solve our issues. That's what I had hoped would happen sooner than it has. It could also happen in the currency market, but it's hard to happen in the currency market when all the G7 countries are all doing the same thing.
Right.
So it's only the bond market. I mean, why would anyone accept the coupons that they're offering you? You're guaranteed to lose money.
It is absolutely
after inflation.
Right. Real returns are negative. Yeah. I mean, all around the world,
guaranteed.
Every sovereign, credit. But it's astounding what they're able to accomplish today. And this might be just a function of the passive investing, but I believe this price-insensitive passive investing really begins with the central banks. Quantitative easing is price-insensitive buying. It's just buying to support prices, and basically investors that just followed their lead, and we're going to just buy assets, regardless of price too. But you look at, I was talking with Steve Bregman, and he talks about, Lebanon bonds, are yielding, 5.5%. People are buying Lebanon bonds at 5.5%, and they haven't even issued GDP in the last 10 years.
Well, hell,
so there's
the goddamn Japanese you're getting -9 or +9. I'm having a look recently for 10-year JGBs, and they're broke.
Yeah,
they're broke.
Yeah.
I mean, in the end, they're gonna the MOF's gonna forgive the BOJ is gonna forgive the MOF's debt.
Japan is really ground zero for this whole experiment, right? Because they're so far ahead of all the other central banks.
Well, they're so much crazier. They're so far out there. I mean, look, they are beyond incompetent at the BOJ. I mean, they presided over this epic bubble in stocks and real estate, and then they can't do anything right in the interim. And then finally, 20 years later, they come in with the mother of all QEs, right?
Right.
So they are ground zero for incompetence. That's for sure.
It's funny to me that investors around the world don't look at, okay, great, the European Central Bank, the Fed, they're doing these policies, but the Bank of Japan is way ahead of the curve in terms of these policies, and look at where it's gotten them. It's fascinating to me that investors don't just look at that, look at the evidence.
Yeah, like you mean QE doesn't work?
Exactly. QE doesn't work, and buying up half your ETFs in your own country doesn't
work.
The stock market.
No. So people don't understand the average sophisticated person, if that's not a head twister, doesn't understand the power of psychology. So you gave an example of how psychology matters, and that same power of psychology is how someday, could be in 3 months, could be in a couple, I don't know, that the bond markets are going to turn on these central bankers. I don't know what the catalyst is going to be. I don't know what the exact connection of dots is going to be. But at some point they're going to say, there's no reason to own these coupons. I would have thought that when they said, look, we're not going to allow deflation. We have a printing press. It's the only thing Bernanke's ever said that I totally agreed with. And yet people still act as like deflation is possible.
Right.
How is it possible if you can monetize the shit out of anything you need to?
Right. Yeah, they'll never let that happen. And
that's
something
when they
can
take
control.
away the printing press, now it's possible. Yeah. That's a step down the road, but
Well, I want to transition and dig into your process a little bit more. I read a recent biography of Jesse Livermore. I read it about a year ago. It came out recently. It's called Boy Plunger. And there's a wonderful chapter that talks about his process in shorting the 1929 crash. And he, made $100 million in his personal account.
Back when $100 million was real money.
A ton of money. And so it was fascinating to read his process through that time. And the first thing I thought of when I'm reading this is it sounds like you. That he would just put out, what do you call it? Like just
feelers.
Feelers.
He would put out feelers.
He'd put out a feeler. And if the market didn't feel right, he'd take it back out. And so, he called his process tape reading.
Yeah.
And just a process of watching the tape for years and getting for a feel how the markets move. And I don't know of anybody in the markets that I would call a tape reader more than you. I mean, would you think your process is that kind of a tape reading type of a process?
No. I'm flattered that you put me in the same conversation with him, although he did kill himself. But
and went broke 3 or 4 times.
Yeah. No, but what I was, I don't need to put out little positions to probe. I mean, I used to kind of do that to see how it feels. Now I can see how it feels without putting money up.
Right.
But so this is my 4th bubble, counting Japan, okay? Right. So, and I learned something really interesting in the Japanese bubble. So I learned this way back in 89, that in a craze, a mania, when things get expensive, the next thing that happens is they get more expensive. So when the 99 bubble came around, I didn't get run over in internet names because I knew that they could go crazy. But I got hurt in stocks like Gateway and Dell, where I said, wait a second. In late 1999, everyone was buying hardware constantly anyway. But on top of that, we had Y2K. Well, after they redid everything for Y2K, there was going to be a big black hole afterwards, right? Because everyone had replaced all their stuff. And PC companies, I would tell people, it's a PC company. It's like making TV sets. There's nothing special. I was sure Gateway and Compaq and just this pedestrian crap, which most of them got out of business,
right,
or got acquired, and I sent pennies on the dollar. And so I got run over in those names because people decided, well, if Pets.com can trade for $50 billion, then we should pay this amount up for. So. But I learned in that period. I had originally set my short fund up where I had to be short, always. I couldn't modulate my exposure much. I had to always be short because people were afraid you were going to miss it if you weren't short. They were still thinking like 87.
Right.
And I realized after the 98 to early 2000 period was just brutal because I couldn't really get out of the way very well. So I changed the strategy in the beginning of 2000 where I didn't have to be short if I didn't want to be. I could be tactically short. Because what I realized was even in crazy periods, it used to be, hasn't been this way, companies would miss numbers, they'd take them down. And then in earnings season, you'd get this cumulative effect and you could make money. Then when earnings season ended, we would go into what Fred Hickey and I would call the no news period because there's no sober news. It was just arm waving on the part of the companies and conferences and stuff like that. So I started to do this where I got very tactical in my shorting, and I did have rules about, okay, I'm not going to turn this into an investment position unless I have certain things that are happening. And then I got even more rules about, well, I'm not even going to be short unless they're losing confidence in the central bank, the market's rolled over, individual stocks are rolling over, stocks are going down on bad news. I have a small set of common sense oriented rules, but those have stood me in good stead. And so those I developed in the first bubble, and I used them well, so I never got really dinged up in the second bubble. And then when it burst, I was able to make a decent amount of money. And then it kept me out of trouble for the last 8 years. I haven't even been, I've dabbled on the short side a couple of times, but so it's more about, I sort of have a really strong opinion about how to go about making money on the short side if you're a short-only guy. Now, there's different ways to skin the cat. Like Mark Cohodes is spectacular at what he does, and he finds these crappy companies with bad management, and they're frauds, and he goes after them. The problem is, it's difficult enough to get a company with honest people to admit the truth when you got frauds. So you have to be ready to go through a lot of torture before you win. And then
David Einhorn wrote a book about the 10-year short battle.
Yeah, exactly.
And he was dead right.
Exactly.
And it's still painful.
Exactly. So I don't really want to do it that way.
Yeah.
But I mean, I have immense respect for Mark, and he's on a big win streak right now. A bunch of his shitty Canadian companies are falling apart
Right.
and otherwise. So he's on a roll, and good for him. I don't want to. That's just way too much mental stress for me. So I've sort of figured out. I want to get the sweet spot of making money on the short side. I don't want to catch the top. I like to say I want to shoot him in the back. I want him to roll over and start to go down and be responding to bad news, because you make all your money on the short side by pressing at the right time and then getting out of the way at the right time. It's not about the research file that you built. It's about knowing when it's safe to express your opinion and when it's not safe. Oh, I put it on. Oh, I got to get out of the way, right? So this is what I've come to learn from, being basically on the short side for 20 years, even though I haven't been active on it for the last 8. And so I have a whole group of rules, and that's how I look at it, because I want to make money when I can make money without having unusually high amount of risk. And so I look at every position I take on by how much am I going to lose if I'm wrong. It's the first thing I think about. Is, okay, so where am I getting out? Where am I getting out if I'm putting this on, right? So, I mean, you and I were talking about the semis earlier. They are one of the fattest pitches out there, in that end markets are saturated. There's a huge cell phone build going on in China, and they're going to way overbuild because there's a zillion producers, and they all think they're going to take market share, and none of them will, and there's too much capacity. Then there's autos, which has been the saving grace for a lot of these chip companies, except now we're seeing there's excess auto inventories. Residuals are going down. The used car market is telling you there's a problem with autos. It's all been pulled forward. So you got PCs are nowhere. Servers are still okay. You got cell phones, which are saturated. This Apple iPhone 8 is another Me Too product. How it does, I'm taking the under on what everyone thinks, but that doesn't really matter. There's enough problems out there that these semiconductor companies are so tipped up. And the thing that people don't recall is when you have excess inventory and it gets too much, orders stop. And these quarters go from they thought they're going to make 60 cents to make 20 or some number. And these things have all been running up. They've ignored bad news. But I'm not sure a share of them right now.
I remember, a lot of the best short targets for us in the late 90s were the semiconductor stocks.
Right.
You could see them stuff the channel.
Yes.
You could see it on the cash flow statement. And then I would see, 3 or 4 insiders dump a ton of stock.
Yeah, because they had to paint the garage.
Right. And you would go, okay, they're not going to make the quarter next quarter.
And you're already seeing what happens is days receivables start to blow up, inventories balloon. Receivables balloon, inventories balloon, and it's all starting to happen. But I have not seen a cycle. So in my last 20 years, I haven't seen a cycle like this where they've been so willing to ignore these signs. These signs would normally start to matter. But in this cycle, nothing seems to matter.
Yeah, it's fascinating to watch. People forget that semis are so cyclical. They're cyclical businesses,
right?
And they're trading today as if things are going to be great indefinitely.
Well, and the other thing is you can get a lot of data points on them because all their customers and all their suppliers are public companies.
Right.
So you can listen to enough conference calls like my friend Fred Hickey does. Nobody knows these things better than he does. Right. And there's a huge list of these popular stocks. They're going to get annihilated. Yeah. But for right now, nothing matters.
Right.
So the trick is to start to build a list, know what you're going to go after, what you're kind of looking for, and then wait for some sign that it might be safe to do it.
So you're talking about reactions in the marketplace on bad news, bad quarter, and actually people selling the stock instead of it sells off and comes right back.
So if you went through the checklist, okay, the Fed's not in easing mode. Right. But they still have tons of credibility, and there's still the residue coming off the balance sheet and the other central banks. So that's not a great environment for shorting, except the stock market was kind of stalled out here in America, and then we had this immense run after the election based on premises of things that are not going to happen. So that's kind of interesting. But, the market's been hitting new highs. I personally don't like to short stocks when they hit new highs with the market. But it looks like, maybe there's some exhaustion. So what I would like to see is the market break, have some kind of a failing rally. The beauty about a failing rally is it tells you where you need to get out. You're wrong. It's, so you get a failing rally to get started on. You get a failing rally in individual stocks. You can put stuff on. You know where you're getting out. You know where you're going to be told you're wrong.
Which is if it does make a new high, right? So you see an initial decline. It rallies back up. It doesn't make a new high. And that's your opportunity to maybe put out some feelers like a Jesse Livermore style. And if it does make a new high, then you take them off.
Yeah, because most big declines, there's a failing rally or two or three or whatever.
Yeah.
So the failing rally tells you there's information. Maybe it's finally over. Maybe we've seen exhaustion. In these manias, nothing ends the mania except exhaustion. Right. And so you can't say, well, I want the... You don't know. So if you have a failing rally finally, maybe there's a sign of exhaustion. Plus, you know how you're gonna get out, right? Okay, my premise is we've exhausted ourselves as a failing rally. So if it gets back up there to where it came from, it doesn't necessarily make a new high, but if it starts doing that, then you say, okay, I'm wrong. Now you might have to dance around. It might go up there and wiggle around. You might have to do a lot of shucking and jiving along the way, but that's the principle, right?
Yeah.
And then you can use the same principle of the individual stocks. You put on a starter kit of these few things, and if it starts to work, then you got to go to town and lean on it.
Yeah, well, this is fascinating to me because, I'm a fan of Stan Druckenmiller, and, he gave a speech a couple years ago where he talked, I'm going to mess up the quote, but he said 80% of the big money that he made over his 30-year career was in the bear market.
Yeah.
It was essentially what he said, taking advantage of central bank mistakes.
Yeah.
But it's these opportunities, like you said, pressing the short side when it's time to do that. He said 80% of the big money he made was doing that. So, and over the last 20 years, if you look at opportunities to do that, that 2008, if you were positioned right, look at all the guys who were heroes a few years ago. John Paulson.
Yeah, well, the
problem.
The problem with 2008 from the short selling standpoint. So, I was up 42% that year, and I'm saying that because I'm admitting that I didn't do a very good job. If you'd have told me the S&P was going to be down 38 or whatever it was, I'd have said, I'll be up 70 or some big number.
Right.
The problem was they kept changing the rules on you. And the volatility was so insane that, I was glad to be up 42% that year. But I sort of felt like I should have done better. But except for I had these immense drawdowns, and I'm trying to be careful because when
some of those rallies.
Well, they changed the rule.
The Treasury's coming.
Well, I had these guys I knew that were running a market neutral fund called one night when they said that they're going to ban the selling of financials, and of course anybody who wanted to be a financial could be IBM, Winnebago, etc. But it blew up all these long short books. So they didn't really accomplish what they wanted to. They blew up more guys that were not making money on the short side. Why they should have targeted them? They weren't really trying to do that. They were just trying to stop. They're stupid enough to think that was going to stop the carnage in the financials. But that year was so insanely volatile that it was so easy to get run over that it was tricky. Yeah,
those rallies I remember, during when over the weekend, Fed and the Treasury had getting together with the tops of the Citibank, JP Morgan, and then they come out and announce some huge bazooka program, and market rallies huge. And you think, maybe that's the bottom, and then
it was insanely stressful.
It was so wild.
And I tell you what, people don't appreciate how close we came to losing the system.
Oh, yeah.
I would tell people, look, I'm short, I'm long gold. I got a custodial account where I can move all our assets immediately, so we can't, if Goldman Sachs traded like $2 lower, I was gonna close the fund, move our assets, and go to cash and just let things. I say to people, I'm short, I'm long gold, I got a custodial account ready to go, and I'm scared to death.
Yeah. Well,
and how are you?
How many people realize that it wasn't the
Fed
many. That actually saved the economy and the markets? It was just the repeal of mark-to-market accounting.
Yeah.
As soon as they said, you don't have to mark-to-market anymore, you can mark to make-believe, that was the day the market bottomed.
Well, and plus I think also, the money they'd done and the damage had been done and, and all. I think that it was...
But it was when the banks overnight went from being insolvent to solvent, just based on the accounting rules.
But then basically everyone had to go with the wink, right?
Sure.
But again, psychology.
Yeah.
The point I was making earlier,
Right.
Psychology, how powerful it can
Well,
be.
it is. I mean, that's a great point because it really is right now. The market is just a big confidence game.
Absolutely.
Absolutely. Was it Kuroda has said, the Peter Pan, as soon as you doubt your ability to fly, you lose the ability to fly for forever.
Yeah.
Right.
Yeah,
so it's like
yeah.
he knows that, right? It's all about the central banks keeping the psychology going because as soon as the psychology shifts, it's over. They can't do anything about it.
And one day it will. We just don't know what the precipitating set of events will be. And I think that given the structure of the market between the ETFs and how they have there's an illusion of liquidity that doesn't exist. Right. The hot money, the ETFs, and all the algos and the derivatives. It's all and the people selling vol. Those are all those things and things that we don't even know about are going to conspire on the way down to make everything go in one direction. Same as portfolio insurance did. The illusion, the fallacy of portfolio insurance was the liquidity was assumed to be there at every price at all times, and it wasn't true. And that's what people think now. I don't see how the market can unwind without a crash. Now, we also know the central banks have sponsored this bubble. They don't call it a bubble, but they've taken credit. So they are going to ride to the rescue sooner than they might have in the past, I think. That doesn't mean you can't have a big air pocket, but in terms of a meaningful future of how things are going to unfold, we're going to have a big wipeout, and the central banks are going to ride to the rescue. And when that happens, we're going to get to see about what the next 5 years after that are going to look like, or 2 or 3. Do people believe them? How far does it go with that? That's what I think anyway. So while I'm kind of excited about the opportunity to make money on the short side, I know it's just a trade. The part that interests me is what happens when the central banks ride to the rescue. Do they start to take the printing press away, or what weird things happen? That's where real investment opportunities are going to be. Oh, I hope or not. They may not be, but if they believe them again, I think I'll go back to. I'll see if I can get a job in writing code, cutting code somewhere. Maybe I can get a beginner's position at Microsoft, an entry-level position at Microsoft.
Right. You talk about the stress of operating from the short side, especially when the powers that be are conspiring against you. How do you deal with that stress? I mean, physically. I know you're a tennis player. I mean, you just go bang it out on the tennis court, and
Well, I go to the gym too, and all that. But and I would never have survived either of the two manias if it hadn't been for working out and playing tennis and stuff. But this go round hasn't been as stressful because I'm not doing day-to-day hand-to-hand combat.
That's a great point. Yeah.
But I learned that. I mean, I know for a fact the 98 to 2000 period, the 18 months from October of 98 until March of 2000 was 18 months. Was like 10 years for me. The real estate bubble, they really only got to me in the last 6 months, because what happened was when the very first payment default started in early 2007, I knew the real estate bubble was over, and I knew the economy was going to get taken with it, and the whole thing was going to be a disaster. And of course, the only stocks that really responded were the subprime and Alt-A lending guys, and the rest of the market kind of took off and kept rolling into the summer of. So that 6 month period kind of made my head spin, and that was pretty stressful. And then trying to make money in the 2008 break was stressful too, because they were changing the rules all the time. So in the last 8 years, I've mostly messed around on the metals market, and of course, the only thing that's harder than being short is being long gold stocks or gold. I mean, Jesus.
Yeah. When the central banks
we should get a degree of difficulty premium when we get paid. Oh, you made $100 in gold, you get $150.
Right.
You made it in silver, you get $180.
Right.
You made it in minors, you get 2x.
You know, that's also a great point as to where we are in terms of the cycle in precious metals, too. I think it's fascinating. I just see so many parallels today, between today and that 2000, time period where financial assets were just so loved, and real assets in gold was just, dirt cheap back in 2000. And I see a lot of similarities today where, we talk, I call it the everything bubble. Stocks, bonds.
I think it's a great name for it.
Is everything is overvalued. And
because everything's
assets,
priced off of government paper, which is dramatically manipulated by the central banks.
And, you look at, how cheap is gold relative to financial assets. And it's probably, I think the last time it was this cheap was 2000.
Really? So I haven't really looked at it that way. I have not been able to use kind of ratios and things like that to help me all that much. But so basically, 1800 gold is the equivalent of $300 gold. Or so we're not 1800. What am I talking about? We're 1200. So 1200 is equivalent to 300. So I can believe that.
Well, I mean, and it's I can't remember who put it out, but it was one of the big houses put out the ratio of financial assets to real assets.
Yeah, no, I know what you're talking about. I saw that. Yeah,
the difference between the S&P and the gold price, and when you just subtract gold from the S&P, you get to a number today that is as low as it was back in 2000.
Oh, right.
Just looking at the difference between.
Yeah,
the two.
okay.
So I think that's pretty fascinating. And
because the S&P is a big index, right?
Yeah.
It's not goofy like the Dow,
right?
Where they cap weight it and they rearrange it. There's only 30 stocks and they rearrange them every so often.
And still, sentiment wise, in terms of gold, every time it sells off, you just see the gold haters just come out of the woodwork, and they just love to pounce on and say it's going under 1,000. It's going to.
Well, the thing about gold is everybody's got an opinion, and no one knows anything.
Right.
Because what are you going to know?
Right. Yeah. Right.
I mean, supply and demand is not going to change that dramatically, except for investment demand, which is a function of, it's sort of it's a function of the inverse of confidence in the central banks.
Right.
So, investment demand is the only thing that can change to really change anything. And it's hard to get a feel for that. So everyone looks, I see people write these articles all the time, and I can tell they don't know anything.
Right.
I mean, I don't really know anything. I was a director of Pan American Silver, which is one of the bigger silver producers, for 15 years. And, I know enough about silver and gold to know that I don't have a clue where the price is. All I can do is kind of look and see how's it behaving, and is it responding to the news in a certain way, and all that kind of stuff. But I mean, I can't believe the number of people who think that they know where it should be priced down to about 3 decimal points.
Right. Yeah, and when you talk about the taking the printing press away, if the central banks are in the bond market so heavily, we might see that type of activity in the precious metals before we even see it in the bond market.
Could well, I think they're similar psychology. Yeah. Right? Lack of confidence.
Right. So confidence is buy treasuries. Right. Lack of confidence is I'm selling my treasuries going to precious metals.
Right.
So,
right.
Yeah.
So we're not. I don't think we're going to have any chance to know how that's going to play out until stocks crack, and then the Fed has once again shown that their policies didn't lead to a self-sustaining recovery. Here they are having to rescue the stock market again. I don't know if the next version of that's going to sober people up, or it'll be that in conjunction with something else. I don't know, but if their policies worked, Trump wouldn't be president.
Yeah. Well, this is a total change up from where we've been. We probably need I need to refresh my glass of wine to move on to this next. You are more than most professionals, guys that you read about, whatever. You're very generous with your time, your opinions. Where does that come from?
I don't. I never really thought about it. Maybe are you referring to the Q&A on my site?
I'm just saying, not just your site, but I loved your. I'm a Real Vision fan, and I loved your interview with Grant, and you gave Grant, generous with your. I mean, you've had me here in your house for an hour now, and you're letting me just.
It's easy to do it if they're people you like. Yeah. Like Bubble Vision calls me, emails me, they want me to come on. I can't stand the network. I think they're the devil. They embody everything that's wrong in the financial markets.
Well, it's the buy and hold propaganda is the whole thing driving it.
It's everything that's wrong. So I don't like them. I don't go on. Nothing against the individual people there, but I don't like what they stand for. Some of the people are jerks, but.
But I mean, you were writing for MSN for a long time.
Well,
I mean, I've read your stuff.
What happened was I started writing this column in '96, which is a complete fluke how that happened, and then I moved it to Jim Grant's when he had an online site, and then I briefly spent time behind enemy lines there at realmoney.com, which is part of thestreet.com, which was a torturous task, and then I set up my own website. And when I set up my own website, I decided to have a Q&A because I would get emails from people, and I feel like answering them because usually if somebody sends you an email, 5 other people have the same question. So when I set up my website, I put in this Q&A for people who can ask questions. And I have come to find, I think I spend more time on that a lot of times than I do on the column because, quite frankly, lately, there's been nothing to say.
Right.
So there's no point in writing a column about, describing the inner wiggles of stuff that doesn't matter, right? Yeah. Who gives a crap if Cat was up and Deer was down and, Eli Lilly was takeover room. I'm making stuff up. But, yeah. And the Q&A, answering the questions, people send me information. I get stuff I wouldn't necessarily see. Having to answer the questions, I have to clear my own head because I have to be consistent.
Right.
And I'm against these manias which run in big sweeps of time. So it's easy for people to say, "Oh, wait, you told me that 2 years ago. You're crazy, right?" And that's what happens in these big manias. Is the people that point out that they can't possibly work and what's wrong with them, they lose all credibility because it goes on longer than the average person can think that. They think, "Oh, it's a bad policy. It shouldn't last very long." They don't understand. They just go a long time.
Right. Yeah. Carl Icahn, was it almost 2 years ago, came out with his Danger Ahead video on his website. To try and part of that video was saying, if more guys like me had come out and warned in 2005, 6, 7.
Look what Stan did.
Oh, and he's ridiculed a year later.
Yeah.
Stan Druckenmiller, right?
Well, and because he's the genius that he is, he flips on election nights to get long. But I don't know if he's still long. I mean, but
you subject yourself to this criticism and whatever, and I mean.
So I don't, so I only do interviews or do things for people that I respect and like, so it's not like it's every hour every day, right? It doesn't require that much time. The website requires time, but like I said, I've got a lot of these people that have been readers for 20 years. Right. A lot of them have been around for quite a long time. So, I don't know, it's just part of what, my routine is now. I can't imagine not doing it. I mean, some days I get fed up, of course, like anything. But, sure. So I don't think I've done anything all that heroic, quite frankly.
Well, maybe not heroic, but, most people don't want to. I mean, it's hard enough to go against the grain. Than to put yourself out there publicly.
Well, when all your mistakes are live in real time, this piece of crap that you own, just got drilled because of this, or you're short this thing and it's up the limit. That's not fun.
Right.
But what can you do? I mean,
yeah. Well, I don't know. I think there are just a few folks. I mean, one of the reasons why I wanted to come here and talk to you is because you have been consistent about trying to educate people and inform people about these central bank policies and whatnot. And it is to a certain extent, a voice in the wilderness, right? There's not a whole lot of people out there, that are trying to spread this message. And I think it's something that needs spreading.
Right, look, I was naive enough to think, okay, I'm going to write this book.
Yeah.
I'm going to explain it all to everybody. Well, here, look how dumb I am. I thought after the first stock bubble, people would sober up, and that would be that. Remember, I set up the whole fund, fund, and I thought, okay. And then, when nothing like that happened, and we had the bigger, crazier, more devastating, leveraged lending and real estate bubble, I naively thought, okay, I wrote this book. I chronicled all the crimes the Fed had committed, financial war crimes, so to speak. And I thought, this is going to really make a difference. People are going to read this, and they're going to realize the Fed's the problem, and that's going to change thinking and all of that. And how dumb was I? I mean, really.
Well, that's one of the...
I mean, come on.
Nobody
cared. Now, I will say one thing. My favorite thing about writing that book is, honest to God, it's in about 15 different languages. A friend of mine was in a bookstore in Mongolia, and he found a copy of it in Russian.
Wow.
It's even in Bulgarian. It's all these little bitty languages. So that part's kind of cool. I like that. I like that. That part's... Yeah. So, look, I feel like from a personal standpoint, I did what I could.
Yeah.
And, but no one cared.
And that's one of the things that, for me, I'm 3 bubbles in, not 4. I was a little too young for the Japanese, bubble. But is thinking that, you get quickly disabused of the notion that you're going to be able to convince people with logic. Right?
Yes.
Because, there's other forces at work, right?
Like psychology.
Exactly. It's not logic, but
no.
I got one more question for you. What is the most common misconception about you? What do people get wrong about Bill Fleckenstein?
Oh, I think I see people okay. What bugs me when people say it? How about that?
Okay.
When people call me a perma bear,
right?
Because first of all, the connotation of a perma bear is some dour, sackcloths and ashes, like zero hedge.
Right.
They won't be happy till the world ends.
Right.
When the world ends, they'll be happy.
Yeah, they're probably the only real perma bear out there.
Now, I'm not rooting for the world to end.
Right.
I was only I knew there were bad policies. I knew they were going to lead to disaster, and I was rooting for it to happen so everyone would see there are bad policies, so we could fix them and pursue sane policies. So I was bearish because the policies forced me to be bearish, and I was hoping that the consequences of them would put us on a better path. So I'm not permanently bearish. I haven't expressed my view on the short side in 8 years. I knew it wouldn't work, so there's some pragmatism involved. So I don't like the connotation of being called a perma bear, and I don't think that I am. I don't want to own stocks, even though I think they might be going up, because I know if they go in, look, if I believe in something and it goes against me a certain amount, I can take it. If I don't believe it and it goes like an eighth against me, I'm out.
Right.
Yeah, I actually bought Facebook in 2000, was it 11, 12? I don't know. It traded at 26 and change, 27.
Right. Yeah.
So I bought some. I don't know. I'd come down.
And it was so hated from a sentiment perspective. People thought, the IPO.
And it traded in a way that I thought I understood. I thought, okay, I can. The goddamn thing went about $0.50 against me, and I puked it.
Oh, God.
And now I made no money.
Yeah.
And now it's 150.
Yeah,
now, I never would have stuck around for the whole part of the trade.
Sure.
But, I did that. And after the mania, I owned some normal stocks like Eli Lilly and Microsoft and stuff like that. I did the same thing with Apple. Back in 2001, the last quarter they missed before recently, I'd gotten long in it because I really loved the iPod, and I thought this is going to change everything for them and all this stuff, and I could see it was going to be better for them. I was super bearish and everything else, right? But it was 01, so some of the air had come out, but now new craziness was coming in.
Yeah.
They missed the quarter, I puked it. And, it was probably like 9 cents a share,
right,
on a split-adjusted basis.
Yeah, that's ridiculous.
But the point is, when you don't believe in the environment you're in or the thing, it's hard to stay with it. And so there's 2 examples of things that I did really pretty right for the right reasons. I didn't really believe in the environment, so I got shaken. Whereas if I believe in something, I can let it go against me a certain amount within a certain construct. So I got off on the tangent. I was talking about being perma-bear and not being a perma-bear, and I was giving you a couple examples.
Well, just the term perma-bear isn't in, because you don't hear it at bottoms, right? You don't hear it at bottoms. You hear it when the markets are doing well, and it's a psychological construct, right? Rather than dealing with the actual issues that you're presenting with the market,
right?
It's classic, debate fallacy, right? Rather than dealing with your issues, I'm just going to call you a perma-bear and write you off.
Right.
So it's almost a sentiment signal when you get it called a perma-bear.
Well, I haven't been called it lately, but I'm just saying over the years it's happened.
Yeah.
And And I think there's a connotation that you're out there yelling at the rain, you know what I mean?
Right,
It's like,
yeah.
and so so that part I don't care. But I mean, you made me have to stretch to think of something. I mean, it's like
Yeah.
it's not much that we're lucky to be in the industry that we're in that we get to live, we can ply our trade where we want. You live in Bend, I live in Seattle, and we can use our brains to our advantage. So if we were complaining and whining about our industry, we'd be.
Well, that's actually one.
It's not like we like it to be, but
right. One of the questions I was going to ask, and I just kind of tossed it while we were talking, was, but this kind of gets at it, is what's the biggest mistake that investors make? And it might just be thinking that there's just only one way to make money in the markets, which is buy and hold, because there's so many other ways to be successful in the financial markets other than. This propaganda right now is so powerful. Buy index funds and hold them. You won't lose money. And
well, I think, I always try to ask myself, what's my edge? And that's not a unique observation on my part. Many guys have said that, but I think, and you don't have to have like some super secret edge, but you have to say, well, okay, I have some tactics that I've honed. And they've worked pretty well. So my edge is kind of my tactics and how I do. So if you're the average person, you have to say, well, I mean, the average person would say, well, I have a long time horizon. True. If you're young, you do. But, the problem is, and this is difficult, how do you're a young guy, we're a gal, and you're in your 30s, and you're in a good field, and you're making good money, and you're putting money aside, you're trying to live your life, financially prudently, but what are you supposed to do?
Yeah, you get nothing in a savings account.
Yeah, you get nothing in a savings account. So you read a column by guys like me, and you say, well, that guy says it makes it sounds like it's too scary to own anything. And so then they don't own anything, and then it keeps going up, and they wait a year, and then they go get involved. So it's not so easy to what do you tell the average person how to I think what you have to tell them now is, look, take some amount of money and just have it be in cash or something, because something bad's going to happen. It'll be big. And, you'll have more ability to think rationally, being able to think rationally in a bad period, right? Because, or you can, or you have to say, you have to have a plan of what you're going to do to try to reduce your position all the way down. That's so hard to do for an inexperienced person. Yeah. It's so easy to get frozen. I mean, you know what it's like.
Yeah. In March 2009, to try and buy stocks in that time, or buy real estate in 2011, 2012, the average person just can't do it. It's just the sentiment is so strong.
So I mean, I don't have an objection to a person thinking, look, I'm not good enough to shuck and jive, and the most part I'm going to try to just sit. But they also have to be aware that they have to examine the argument. Okay, has everything been warped by the central banks? No, I don't believe that. Well, they're not listening to this interview,
right.
And they're going to do really well until they go over the falls, and then they'll have to figure out how they're going to deal with that if they can. Other people are going to say, well, yeah, maybe it does make some sense. Well, how much sense does it make? Where are you in your math, your financial equation? How are you going to deal with it? I'm sympathetic to the question of, because you could tell if you took us with what we know now and turned us into young people again, with limited funds, we know enough till we could take a modest amount of money and figure out a way to build it. We'd sit and we would do. But we've learned those lessons from making our mistakes and doing all this stuff. So to the people that haven't done that yet, trying to give them advice to navigate it through is trickier. So we're so far into this and we're so late in the game. I don't have any problem telling somebody, look, just go to cash. Let's look at it in 6 months. If we're wrong, there will be information in that, but you're probably not leaving that much on the table. I had a younger guy, who I happened to ski with, one of the guides up where I go heli skiing, and he's heard me talk over the years, and he said, what should I do? I said, you know what? I think 2017 is going to be a train wreck. Once this election round, and I said, you should just take your funds and move a lot of them to cash. Well, he has. Well, he's in Canada. Hadn't cost him anything because the Canadian market's not really doing much, right? So anyway, I got off on a tangent, but I think
it comes back to how we started the conversation about being a snob. Be in cash until there's some opportunities to put money to work. That's not 0% real return in bonds, or probably negative real return in owning stocks.
Yeah, you could lose 20% or 25% in the stocks or the stock market in a heartbeat.
Yeah.
You're not going to lose that to inflation for 6 or 7 years.
Yeah.
So you're not making anything on your cash. You just have to wait. Cash, as Seth Klarman says, is an option on. I can't remember exactly how he says it, but it's an option on
opportunities.
On opportunity.
Yeah.
So bonds are dead for sure. You're losing.
Yeah.
You're losing versus inflation. If it's short enough, you probably can't lose any capital, but you're not getting anywhere. If it makes you feel better to own a few bonds, fine. You're not going to lose much. You're not going to make much.
But this that brings up a good point too. This might be the first cycle where we see bonds are not a very good hedge when stocks go down. Right.
Well,
in the past, that's what people have counted on.
Right.
In the 60-40 portfolio.
Well, there's another. There's another wild card is risk parity.
Right. Yeah.
What's good now? Paul Jones is one of the smartest guys in our industry. Thinks it's going to be a big problem. I happen to too. I know about 1/10 about whatever he's thinking about it that he does, and so there's another wild card. So I think there's no. I think we finally gotten to a place where I think for the average person just to have a boatload of cash and say, look, over the next year, my opportunity cost is going to be a couple of % in fixed income, and maybe I'm going to miss out on 5 to 10 in stocks. But I'm putting myself in a position to potentially not lose 15 or 20, and then have the mental clarity to be able to take advantage of a real opportunity.
Yeah. 15, 20, 30, 40, 50.
Well,
we're looking at
I would say 60 or 70 if I didn't know for sure that the central banks were going to ride to the rescue. Yeah. So you're only going to be able to lose 15 or 20 or 25 right off the bat, and then they're going to ride to the rescue, and then there'll be the bounce and the do-over lifetime, and then we're all going to get to decide what we really want to do.
Right. Well, this has been a fascinating conversation. I've taken up a ton of your time. I'm really grateful to you to take the time, Bill, to do this and share your thoughts. You have plenty of experience and wisdom to, especially from a unique perspective of a guy who's done, from the short side, something very different.
I've been behind enemy lines for a long time.
Something very different for a long time, and I think it's fascinating. This is not the kind of stuff that you get to hear from most of the media outlets and whatnot. So I'm grateful to you. Thanks for doing this.
Yeah, it was really fun. You asked me really great questions. It was really a ball. I had a great time.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. You can find Bill online at fleckensteincapital.com. There he writes a daily column in addition to his Ask Fleck section, which he mentioned in our conversation. I'll also put up some notes and links on my site at thefelderreport.com/podcast. And I want to thank you all for listening. I hope you enjoyed it. And until next time, buy low, sell high.
Looking good, Billy Ray.
Feeling good, Lewis.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.